And how's it going, everybody? My name is Antonio, and I am on the barbecue on December 21 with Philippe, CEO of Cartier Resources, a gold exploration development company with 7 projects in southwestern Quebec on the Abitibi Greenstone Belt. Who's not here with us today, though, is your financial advisor. This conversation is not going to include any recommendations to buy or sell anything. Instead, it will be a casual, general, and an impersonal talk between two people on the internet. And if your mom didn't tell you, you're not supposed to trust strangers on the internet, at least not blindly. So please do not use this conversation as independent and conclusive research, because it's going to include a lot of forward-looking statements about uncertain events that may or may not happen in the future, and also because the exploration space is among the toughest places to profitably deploy capital in, because there are risks, or as they are with any investment. So you, again, need to do more research and take your own responsibility. Head over to setterplus.ca and read the company's official filings, as well as consult a professional investment advisor before taking your own decision in the end. That all said, Cartier Resources is listed on the TSXV under the ticker symbol ECR, where an average of about 170,000 shares trade each day, with a 52-week high of 18 cents and a 52-week low of about 7 cents. With a market cap of about 33 million Canadian dollars and about 350 million shares outstanding, today this is a 9-cent stock. There are 7 million warrants and about 20 million options that are still outstanding. That's resulting in about 380 million fully diluted shares. Over 15.5% of the company is owned by Agnico Eagle. It has been that way, I believe, for over 6 years now. Another over 14% is in the hands of Jose Vizquera's O3 Mining. And then the management and the government of Quebec also own small portions of the company, resulting in a free float of about 64%, although one portion of that, the company says, is in the hands of long-term retail shareholders. As of the end of September this year, the company had a little over $3.1 million in current assets, was mostly made up by $2.7 million in cash, and that sat against pretty much nothing in current liabilities. It was just about $300,000, resulting in working capital of a little under $3 million. But that's probably changed by now, especially because Cartier recently closed on a private placement to the tune of $2.5 million. The company spent about $1.3 million on G&A during the first 9 months of the year, which means that they spent roughly, we can round it up to about $150,000 a month on average this year so far, to keep the lights on and the staff happy, at least as happy as it is possible to keep exploration staff in this market. But boring stuff to the side. As I said at the beginning, Cartier now has 7 projects in total. 3 of those are not as active. The other 4 are more active, but there is one flagship asset that is really the focus here, and that's a past-producing gold mine called the Chimo Mine. It's a 100% owned asset, and it's located in the Golden Valley, or Val d'Or, as the locals call it, locals of Quebec, of course. This is an advanced stage asset. Cartier has invested over $20 million in it over the last 5 years. They've drilled over 80,000 meters, and they defined an almost 2.5 million ounce deposit. That's across the indicated and inferred categories of the NI 43-101. And the mineralized system here exists of 30 gold zones. They're spread within 19 structures, which themselves are spread, divided into 3 gold corridors. There's little guessing left here, though, because after consolidating with its neighbor to the east, Cartier Resources published a PEA. That's an economic study showing the financial viability of the project. Basically, they did that earlier this year. And that PEA was done with the assumption that this will be an underground mine, and it also assumed that $1,750 gold price will be achievable over the life of mine, and it also assumed a 5% discount rate for the financing of the mine. Now, those assumptions together showed a total expected production of 1.4 million ounces, resulting in a net present value of $388 million and a 20.8% post-tax IRR over a nearly 10-year period. And the study said that it will take a little over $340 million to build the mine, with total payback of the capital expected within less than 3 years. Part of those positive economics, by the way, here are driven by the existence of a shaft on the historic Chimo mine. It's an almost 1,000 meters deep 3-compartment shaft that, according to the engineering firm that first looked at it, can still be partly used today without any major upgrades. And The firm, by the way, also thought that it would cost up to $150 million to build that shaft again, had it not already been sunk. There's also direct access to a power line. Since this is Quebec, we're talking about very cheap electricity over there. And there is also a permitted tailings facility, obviously, all of which pushing the capex down, of course. Now, while moving further to the right on the Lassonde curve, Cartier is not standing still, though. They're still planning more exploration to come, with the main goal being, of course, to improve the numbers that I just told you about in a PEA and just generally grow the asset. The main reason why they believe this could be achievable is that the current PEA only covers about 3.7 kilometers of the, in total, 15 kilometers long strike length of this of the mineralization here, on which also historical exploration has been done. Over 800 drill holes have happened, as far as I can tell. As well as some geophysics have been done, and they have shown the same type of alteration, mineralization, and structure as what we see at the Chimo mine. And also from studying that historic data, 11 new drill targets have been identified, and Cartier's own drill program from this summer at and around the PEA part of the land package also showed multiple narrow but high-grade intercepts of gold, again suggesting that there is potential to grow the resource here, as the strike length of the deposit has already grown, by the way, from drilling this year. So going forward, yes, there are more projects, there are more plots of land around the Chimo mine, and again, all of which within Quebec, but Cartier is determined to continue drilling around that known shaft in hopes of growing that 2-point-something million ounce deposit that I told you about to hopefully, and these are the forward-looking statements I told you about, a 5 million ounce gold deposit, while also potentially improving the metallurgy, the upfront capex, at least on a per ounce basis, and just improving the economics of the project. Suffice it to say, there's plenty of work, plenty to be talked about, which might mean that it's a good time for me to start shutting up and welcoming the CEO, Philippe Cloutier. Sir, thank you for investing your time with me today.
No problem. And you did an excellent summary. I wonder why we're doing the interview.
Pleasure is of course mutual. Thank you for the kind words. I do try to prepare as well as possible. But what am I missing or forgetting or getting wrong in the overview of the company, or something else that you want to add here?
You hit several key points, so I'm going to try to go in order. Indeed, we earlier on in your summary, you mentioned that we recently raised cash. All right. And so that sets us up with $4.8 million entering the new year. And that's essentially to service much different exploration program from the one that we've been doing over the last 5 years. The last 5 years have essentially been exploration around the shaft, the current shaft and underground workings within a 500-meter radius. And the reason we did that, obviously, because, well, originally that's all we had, a very small property. And by late 2020 and 2021, when we published the third resource estimate, already then and there we had producers in the data room reviewing the project. And it dawned not only on us, but on them, that this thing was going to continue laterally and at depth. And the property boundaries clearly were a limiting factor. So in 2021, we acquired the surrounding ground that by then had been consolidated by O3 Mining. O3 Mining, as you know, have an excellent project in Marban. And they elected to match Agnico's position and sell us the large land asset for just under 40 or 46 million shares. And that's how they became a significant shareholder. And so now both Agnico and Cisco O3 Mining own matching amounts and in the order of just under 30% of our share position. And so the year we acquired that surrounding asset, well, we launched a 25,000-meter diamond drill program. We did a consolidated resource estimate, which you mentioned is just under 2.5 million ounces in both categories. We delivered a PEA. And what we also did was launch a massive audit of the surrounding, well, the immediate 15-kilometer strike length on either side of our Chimo asset. And we audited over about 800 diamond drill holes with the geological criteria that we had seen was successful in discovering and expanding the gold zones at Chimo. So we applied that over the 15-kilometer strike length, and that's how we generated the 11 target areas. And obviously, each and every one of them have very high-grade cores, such as Chimo. But keep in mind that while we did that, well, obviously the PEA was an invitation or a calling card to knock on doors of, an expanded Rolodex of mining companies. And so when you mentioned that we had an exceptionally expensive year of G&A, corporate development, well, it essentially reflects the fact that in 2023, we knew we would be very active trying to raise awareness around the PEA and the recent transaction. And so we went all out on several fronts in the US and Europe and in Canada to market. And we hired, investor relation firms to get us out there. Unfortunately, the markets, we had severe headwinds. But I do know that we have gotten the story, and we seeded the story in a lot of people's minds. And so looking forward, I think 2024 is going to be better for us. Not only are we going to see visitation from what we launched with via the PEA and knocking on doors, but we're also going to enter the year drilling. And this time it's going to just be one machine, low expenses, because we're going to be drilling shallow holes on these 11 targets throughout the year.
I gotta tell you, I've heard that a couple of times for people hoping that 2024 is going to be a better year, and I'm right there with you. I'm hoping as well. Philippe, when I met you at I believe it was in Frankfurt, right? That I met you a couple of months ago, or about a month ago. I was under the impression that you were not going to have to raise money again soon, but then you raised that $2.5 million right now. And then there's also a flow-through portion on that raise, if I'm not mistaken, which is interesting to me because that gives you, it gives you 2 calendar years time to spend it, and that means that it needs to be. So, I mean, by January, it's going to count as 1 year already. So, well, talk to me about that. Why raise it now? What exactly are you spending on? You said you're going to do more exploration. Where exactly is that going to be? Just talk to me about that raise there.
Okay, several reasons. One, we had just seen, or it had just been revealed to us, all this upside potential, low cost, high reward drilling, because it's not prospecting with a drill. Basically, it's going on these established discoveries. Two, for the better part of September, October, or even November, we're drilling in the sub 10-cent range, 7 or 8 cents. And we had a lot of offers to finance and no premiums. And so we, in Frankfurt, it was comfortable for me to say, we're not going to raise money at those levels being 7 or 8 cents. And early December, well, some of the fund managers, flow-through fund managers, were getting antsy because they've got flow-through money to park, and they turn around and says, okay, your requests, we'll meet your requests and raise it at a much higher price than 7 or 8 cents. So, but we didn't need a large amount of money to get a lot of drilling done. And so with $4.8 million in the bank, we're able to go and keep drilling and expanding the potential along strike while servicing any number of due diligence processes that are ongoing by other companies to review Cartier's assets or Cartier, the company itself.
Okay. So there's 4.8 million bucks in the bank right now. You said you have those, you basically have those drill targets ready, you know exactly where you'll be drilling, and it's not going to be as close to the Chimo mine as you thought before, but where exactly on the land package are you going?
Well, if you revert back to the plan map that we have on November 21st, you'll see the exact location of all those 11 targets. And we're not intending to go back on the Chimo mine area itself. We're going to go into those 11 historical discoveries of deposits and showings that were done over a 60-year period. But keep in mind that all these previous explorers never had the benefit of understanding what are the key criteria and the geometric vectors at depth to actually follow up on these discoveries. Obviously, we're advantaged by that. And so that's one of the reasons we're very comfortable walking into this program, being able to drill a lot of holes, short holes, following up on established discoveries. So I truly believe that 2024, early 2024, we're going to have a very, very high success drilling in and around on that 15-kilometer gold strike. And again, I'd like to stress that it's an exploration program that is absolutely different from what we've been doing in the last 5 years. Last 5 years is actually drilling in and around the shaft area on known gold zones at depth, sniper type drilling, expensive drilling because we had the standard drillers and the directional drillers, and quite deep holes, right? This time around, it's in the order of about 130 to 140 diamond drill holes over these 11 targets, and they're going to be ranging between 80 to 150 to 200 meter lengths. One drill in this part of the world per day is about 80 meters of core. So every second day, there's a drill hole being done, right? And we're going to add to that, well, in order to be top-notch ESG, we're going to be drilling this program with respect to, there's some wet areas and swamps that we want to avoid drilling in the summer. And so we're going to be drilling that in the winter. And when summer rolls around, we're going to drill the summer targets. And we could drill year-round on this thing. And again, since most of the targets are well defined by previous drill intersections, high-grade cores, we do believe this is going to be a very successful year, at least start of the year.
So what do you think the average depth is? I'm basically just trying to figure out how many meters you're going to drill. So I might as well ask you that directly.
Yeah, well, it's the full first phase program is about 25,000 meters. The average length of the hole, again, ranges in about, I'd say, 120, 150 meter length. So there'll be some 220 meter holes, but there's going to be some 75 to 110 meter holes as well. And it's going to be a one machine drill program. If we are met with, more than anticipated success, we might revert to 2 drills at one point. But we're going to keep our powder dry and try to go about this as we've always had, a very cost-effective way of drilling this program.
How much is a meter costing you in Val-d'Or?
The all-in generally is about $150 per meter. That's
Okay.
geologists, core, logging, et cetera, et cetera. The winter stuff can sometimes be a bit more expensive if you have problems with water, access to water, and so on and so forth. But that's about it,
So it's a $3 million drill program.
Essentially, yeah.
Or well, no, actually, it could be more, because it's 25,000 meters, right? And if it's 150 a meter, then it's a little over 3.5, actually. Okay.
Yeah, you can round
But,
it off to 4 if you want to.
mm,
But I mean, as this program gets up and going, we'll adapt to it because the biggest part of the learning and earning curve we did during the last 5 years, right? And then keep in mind that at any point in time, depending on the alternative that we select, do we bring in a partner, a joint venture partner? Do we sell the project outright? Do we keep managing the project? Well, there's always the original PEA program that stems from the PEA report, which is a $29 million program, but strictly in and around the shaft area to grow the resource around there to 5 million ounces, to do metallurgical testing, drilling, to do ore sorting tests, and launch environmental permitting. So we have the best of both worlds. And we're going to monitor, appropriately the markets and the market sentiment to keep delivering and keep growing this project.
What does that part mean? Keep delivering. What does success look like for this 25,000 meter drill program?
Okay, well, success ultimately to me is being able to copy paste that the geometrics of Chimo, that let's round it off to 3 million ounces, because we haven't included the 25,000 meter program we just did in and around the shaft has not been added to the new resource system. So let's say we round that off to 3 million ounces at Chimo. If we're of the 11 targets, conservatively, if we were to 4 of those were to develop or keep growing like Chimo, well, you're looking at 4 times 3, which is 12 million ounces.
Mm.
So a successful drill program this year would be, for me, a program by the end of which we're able to say, oh dear, we could repeat Chimo here, here, and here. And so now you're looking not only at one mine, but potentially a mining camp emerging along that 15-kilometer strike.
Mm.
And that's only down to a depth of maybe 500 to a kilometer on these new targets, but definitely down to 1.6 already at Chimo.
Mm.
And as you probably know, the main vector for success along the Cadillac Fault is definitely a steep plunge at depth. LaRonde, for instance, continues at 3 kilometers. Goldex are mining at 1.5 kilometers, and Odyssey, the new Agnico's new mine as well. So it's not rocket science. It's just doing simple, keeping your eye on the ball and doing simple exploration on known gold zones and extending these things at depth and laterally.
Mm. What is
Easy.
part? It is part rocket science because it's rock science, and not a good joke. Forget it. But so what I'm thinking about is the larger the deposit, the larger the capex, right? And this market doesn't seem to be rewarding deposits with high capex. How do you deal with that? Do you think you're going to get the right value if you discover those 12 million ounces, of course, forward-looking statements, but if you discover those 12 million ounces in a camp, do you think you're going to get the right value for it?
Well, at least indicate that the potential's there. We're not talking about measured and indicated ounces. We're essentially talking about scoping out and demonstrating that this part of the Cadillac Fault can behave exactly the way the rest of the Cadillac Fault is behaving. Let's say from the Gold X to Kena and Marban, from around the Cadillac Camp, LaRonde, Westwood, etc., around Wasamac, etc., along Kirkland Lake and V-Town. They're along the Cadillac, which the Cadillac, Larder Lake Cadillac Fault, which is in excess 250-kilometer long. There's a cluster of these mines every 8 to 10 kilometers. And I believe that at Chimo, we've stumbled on one. But, in the past 60 years, it was never assembled under one ownership. Cartier now has that in 2023. So this drill program will simply be to scope out that potential. Can we capture full value? Well, when we started drilling Chimo in 2016 with the sponsorship of Agnico, I mean, it was a different world. Today, the corporate landscape is totally different than it was in 2016 or early 2000s. The economic landscape is different. The price of gold is much higher. I mean, had we had Chimo the way it is now in 2016, it would have been a totally different ballgame. So you could and keep in mind that the PEA that we delivered is, the word says it, preliminary. There are many opportunities that if we revisit this PEA and rework it, there's a lot of upside to it, on an already positive study. Now, yes, $340 million initial capex. That includes building your standalone mill. There could be an analysis done on, custom milling. But there's many opportunities going forward on this.
Mhm. Do you think so? When is that 25,000 meter program going to be done, by the way?
We're launching it on January 17th. It's
Okay.
going to be nonstop drilling, maybe a pause during breakup, because as you know, here in April, when everything starts to thaw, it's always prudent to get out of the bush for about a 2-week period because everything is kind of wet.
Mm.
But other than that, it's pretty much nonstop drilling throughout the year.
Okay. But an indication of when it's going to be done, summer or?
Oh, we'll keep drilling through until maybe next fall.
Okay.
So it's many drill holes. Uh, we're just trying to get all 11 targets done, but we're going to closely monitor the results on the initial ones that we get done during the winter. If we have to go back and continue to expand on a new discovery, we want to have that flexibility to do that,
Hmm.
and we most likely will.
Because you said it's going to be about 140 holes, right?
Yeah. Well,
And
the whole program as it's mapped out on the 11 targets is a total of about 140 holes in
okay,
25,000 meters.
right.
How we pick and choose and how we evolve through that program, well, we'll see once we start drilling in January.
Hmm. Right. Okay. Because then you said you do about a hole every 2 days, so that I thought 70 days, 70 working days. Then I assume, but you have moments of moving the drill and stuff like that in between. Then.
Mob, demob, some holes will be longer.
Hmm.
Will be a pause in that breakup. There might be a pause during the summer. There might be an increase of drilling rate if we decide to bring in a second drill, or there might be just a slow, steady burn throughout the year. So,
Hmm.
yeah.
Okay. Good. But are you thinking an internal scoping study that you announced to the market by the end of 2024? Or is that not something you're looking to do?
Right now, we haven't planned for that because there are things that are ongoing, although other alternatives, and but we haven't earmarked any budget to do that, a fifth resource estimate right now, or an upgraded PA, at least not in 2024. For now,
Okay.
it's going to be exploration, exciting stuff, new discoveries, new high grade cores. That's what we're expecting.
Hmm. Do you think that eventually you'll have to redo the PEA for the Chimo mine, or do you plan on going immediately to PFS?
Clearly, we're going to have to do an expanded PEA because in the most recent program, we did discover new zones immediately to the west. We did discover that even around the West Nordo area that we had acquired with the O3, that thing was coagulating a bit more. And so they most likely will have to refine or upgrade the mining plan and review some of the stuff with respect to ore sorting maybe and vertical conveyors and so on and so forth.
Hmm.
Um, Most likely there will be an upgraded PEA before we even think of going to feasibility.
Okay.
Because when you go to feasibility, understand that you have to take your inferred and bring them into indicated. And when you do that, you're not scoping out or identifying more ounces. You're simply adding confidence to the ounces that are already there. And I agree, and I agree with that concept when you're in a remote area or it's a brand new discovery. But this is a past producing mine where there's already a very well established, geological and geostatistical behavior with respect to known gold zones. So we have the benefit of being able to continue expanding the resource without necessarily going into flipping inferred to indicated and indicated to measured at this phase of the game. I
Hmm.
mean, if a senior mining company or a gold ounce hungry company wants to do that, fine, we're there to accommodate them. But I mean, not on our shareholders' dime for sure.
Do you think it's reasonable to expect some sort of a deal before you even have to do that, though, as what you mentioned now?
I keep hoping and dreaming of that, but at the same time, I have to temper our emotions because what's the point of having worked so hard and then simply selling it at a discount because of our respective share price right now.
Mm.
This asset has tremendous value, in situ value, which is not being recognized by the market. And so precisely, why sell this thing at a discount simply because the timing's not right?
Mm.
You know,
Well, so you've acknowledged you think and dream about these things. What's a dreamable scenario? If you can talk to me about amounts, what do you dream of selling this thing for?
well, we've seen recent compilations of ounces in the ground being sold in the range of $75 to $100 an ounce,
Mm.
depending on the quality of those ounces, right? So if you do simple metrics, like if you've got 3 million ounces, $100 an ounce, that's 300 million. You got 350 million shares outstanding. Right there, you're looking at maybe 80 cents a share. Yet we're trading at 10. There's a significant disconnect between what we're trading at and what we could be trading at. Even if you apply a 50%, uh, depreciation or non-appreciation of our share price, we could be trading at 40 to 50 cents, yet we're still trading only at 10. Our
Mm.
job is to connect and raise awareness, and eventually somebody will say, hey, this is a sitting duck. Um, you know,
Do you think you're going to have to improve some of the other metrics in there, though, in terms of continuity, strip, recoverability, or something else that you're going to be working on in terms of just upping the quality, not necessarily the size, but the quality of the deposit?
as geologists will tell you, you respect your geology.
Mm.
If you try to make, you have to work with what nature's given you. And right now, nature has given us a deposit where we understand its metrics and its characteristics very well. We know that about 25% of the ore that we'll find in an area like this will necessarily be very high grade because past Chimoet had about 25% of 400,000, 100,000 ounces of that was really high grade, and the rest was in the 3 gram range, right? The characteristic at Chimo is you have large volumes of relatively constant grade. So if you want to start cheating your deposit and focusing only on the high grade stuff, you're just going to lower the ounce count. And when this thing was shut down in 1997, metallurgical and mining technology was such that you couldn't even contemplate doing bulk mining underground, whereas today you can. And that's what I was alluding to, that the corporate landscape in 1997 versus the corporate landscape today, like the neighbors that we have in and around the Cadillac Fault, is totally different. The price of gold in 1997, when this mine was operating, was like $400 Canadian. Today it's $2,700 Canadian, right? And the technological environment, mining and metallurgy and environmental things then was totally different than today. So, I mean, we're poised to take advantages of all these incremental things that we now have at Chimo. And we can benefit from that. So why be bullied into a situation where we pretend to be ignorant of all the value that can be built in and around Chimo? And so, yeah, that's the situation at present. Is we have the ability through the transaction with O3 to keep developing and showing that this 15-kilometer stretch may ultimately behave like the rest of the Abitibi and become an emerging mining camp versus a standalone mine. That's what
That's
I'm looking for.
that's something that I do want to talk about for sure. As you're mentioning your neighbors, I was referring to, and I was mostly alluding to, though, and we're gonna go back to talking about that for sure. But I was just thinking for a second here about the recoverability. Right now, it's at what, 93%.
Yeah.
I mean, typical of this type of deposit, you could get it higher. And my question would be, do you want to try? I mean, is it efficient for you to try and get it higher?
Absolutely, most definitely. What we wanted to do is use the data, the historic data. And the historic data of 93% is basically born from the fact, a historical fact. When Chimo was being operated at first, they did not have a mill on site. They were actually trucking the ore from Chimo to Lucien Béliveau, another one of Cambior's mills. And that mill obviously wasn't calibrated for the Chimo type ore. Towards the end of the mine life, they actually they had ceased operations at this other mill. They actually trucked the mill on site to Chimo for the last 2 or 3 years. And by the time they got around to doing all the testing, grinding, and recuperation, they were on the verge of actually bumping it up to 6 or 7%. But what the consultants that did the PA and us elected to do was simply use the historic, well-established 93%. And that's one of the opportunities to better the metrics that I was alluding to a while back. Is just the recoveries from a metallurgical standpoint, either through enhanced ore sorting tests or basic metallurgy, right? That would be done through the $29 million program that is recommended by the PA authors. And then there's refinements that can be done in terms of mine sequences and mine design. So yeah, no, Chimo itself can become better standalone. But what we want to do as quickly and as inexpensively as we can is to assess in the new ground that we've acquired along that 15-kilometer strike, can we repeat Chimo? Can we show the world that very rapidly we could repeat Chimo? And if we can, then we already know the drill pattern that will lead to very fast success at delineating easy ounces. So that's what we're hoping to do in 2024 while monitoring all the awareness that we've generated through the last part of 2023.
Okay. How high of a recoverability do you think is doable here, again, in the realm of speculation?
I'm not a metallurgist and I'm not an engineer. I would like to see 97%, just like the other mines. But yeah, that's my disclaimer. I'm not a metallurgist, and so
Yeah.
I know that people they're going to be working towards bumping it up to 96 or 97, I suppose.
Right. Yeah, this is again a fireside chat, if you will. So we're guessing and speculating and looking up into the future.
Yep.
But let's talk about those neighbors. You mentioned the neighbors. There are a lot of issuers who own land in and around Val-d'Or. I guess do you expect one party to come in and start consolidating land packages? Do you expect it to be a couple of larger parties doing? Like, how do you see the future of the area if we look at it, let's say 10 years up in the future?
This is an area steep in mining culture and tradition. And we've seen very recently collaboration and partnerships. There's a very wide range of competitors along the fault. There's the very small junior like us with assets. There's a mid-level juniors that have exploration to development projects. There's junior producers and intermediate producers, and then there's the super seniors or seniors like Agnico, right? So there's Agnico, there's El Dorado, there's West Dome, there's IM Gold, there's Hecla, there's even Cisco Mining with Windfall, if you want, and recently Goldfields has entered the game. And then you have juniors that have very interesting projects like Probe and O3, and then there's Radisson down the highway. So there's they're very, very interesting spectrum of participants there. And we know that, the Quebec sovereign funds and other precious metals investment funds have all been requesting that the local juniors consolidate right? They, for lack of a better an argument, they keep saying they prefer to cut large checks than a bunch of small checks, in terms of financing or development or taking risk. So I suspect that 2024 and 2025, you'll see either consolidation, you'll see acquisitions, or creative arrangements. Just in the last week or so, you've seen I Am Gold take out Vanstar. You've seen Dundee take out Asino. You've seen Manita try to merging with Nighthawk. So there seems to be a picking up of this corporate reorganization, and so how is that going to accelerate, stabilize, or disappear on the backdrop of the new economic landscape that we're going to be seeing pretty soon in 2024? I don't know. All I do know is that we're focused on keep advancing Chimo, the Chimo Mine Project, as we call it today, and focus on being always ready to service any opportunity that comes our way. And that's why essentially, again, we dozed ourselves and we picked up the money that was there to at least get that done and to continue being relevant on the exploration scene in early 24.
And that's exactly what you mentioned previously. What I'm wondering about is it market dependent? Like, do we have to be in a specific portion of the cycle for us to see this specific type of M&A? Because there's a couple of, again, as I mentioned, there's a lot of issuers that will have to get bought up to consolidate the land packages a little bit more there. It's not one or two. And
Right.
is it cycle dependent, or is it dependent on the companies and what those deposits look like? That's sort of the thing that I'm wondering about.
I look at it several ways. One could be purely cycle and price of gold, right? The other is that when the seniors start to merge and collaborate together, they ratchet up the food chain and they create a vacuum between themselves and the intermediate and junior producers, who now have a lot of space to start to grow themselves, because these companies in the recent decades have never so little explored, and they're counting on the juniors out there to find them new deposits and new discoveries. Yet there's only a select few junior explorers that elect to do the type of work, take a deposit or showing and do resource estimates and PEAs. The vast majority of junior companies keep trying to drill IP anomalies and do some grassroots exploration, which is definitely needed. But in terms of providing for these producers, be they junior, intermediate, or senior, those ounces, they have to be served up on a silver platter as close to a pre-production schedule as possible. And so I think that's another thing that's going to be driving M&A is the gold producing companies are going to be seeking the most advanced or the least risky projects out there. And obviously, when you have projects that are in safe jurisdictions, such as the Abitibi, right now, let's just say we're a lot more popular than if we were exploring in Panama, right?
I can see that. I can see how that's the case.
And because of what I just said, it can be expected that sometimes you get left field offers from entities that are having a rough time with, evolving legal situations in jurisdictions that aren't, that are difficult. And they're now understanding that although projects in secure tier 1 jurisdictions are more expensive, while they're a lot less risky, and they serve up they're more ESG friendly, let's just say.
What about you? Do you have aspirations to be one of those parties who maybe consolidates a little bit more ground, or are you really focused on just growing this thing and then passing it on to someone who's going to do bigger things with it?
Both.
What does that
Both. I
mean?
mean, like, well, I earlier on in the conversation, I said that our job, management and the board of directors of a junior company is to protect shareholder value. And so when you build that value, surrendering it at a discount doesn't make sense. But if you've built true value, you can always argue and negotiate. There's always, meeting halfway. But so if we're met with the right offer, for sure, we'll probably, we could sell it and move on to something else. If not, we have to get creative and continue advancing. But it does not make sense to sell value at a discount. You have to have staying power and make sure that you're able to make it to the right market to sell your project or develop your project on your own terms.
Well, making it to the right market, that's something that
No
you,
control
you've
over that.
you've alluded to that before, right? You often talk about guarding the treasury, preserving the cash that the company has, basically. What does that mean for you specifically? Are you cutting any costs or doing anything specific to keep more of the money that you have right now over 2024?
Well, definitely. Well, the one advantage is we've always had a small team. We're a four-man crew here. So our G&A, if I was to cut all of the hard cash expenses of investor relationships and things like that, well, our G&A is about 65,000 per month. When drilling, like for instance, when we were drilling 2 machines on Chimo in and around the shaft, that was about 750,000 per month versus the new program that we're going to be doing, which is going to be about 200 or 300 per month. So it's like we walking into 2024, we have the option of really curtailing a lot of the hard cash, so to speak, expenditures, minimizing the shows and awareness campaigns that we're doing, because basically, I mean, we did it at the right time. When the transaction was done, when the resource estimates were done, when the PEA was done, we were allocating the right amount of investor relations money to get on the radar. Unfortunately, we were met by really shitty markets, but that doesn't mean the story didn't land. It did land. And I'm hoping some of that reaction we'll see in 2024.
And but that again is, I suppose, market dependent, because I mean, how do you, at the same time, how do you balance a soft market with maybe being less noisy as a company, so to call it? Like, you'll be drilling, there's going to be assays, but if a tree falls in the woods and there's nobody there to hear it, does it make a sound, right? So how do you manage that? So, keeping the G&A, but then at the same time also doing enough marketing and investor relations.
That's a very, very good point. And in fact, recently when I was on tour in the US, I went to New York, and some of these funds were really excited by the news that groups like Cartier were producing. Yet at the same time, they had invested in other juniors that had delivered tremendous value, yet their share price was down. So they were loath to buy into new stories. But so the efforts that were done in 2020, well, in all of the previous years, but especially in 2022 and 2023, to connect with the appropriate investors, be they institutional or corporate or even retail, well, that Rolodex has been built. And that's the one that's going to be exploited or called upon when we start drilling. So it's not like I'm saying we're going entirely quiet. We're just going to pace ourselves through the spending because it's needed. I mean, by now, if people haven't wisened up to what we've built at Chima, well, adding a layer of pizzazz or one extra show, like going to an extra show, is how's that going to change things?
Mm.
You know, and quite honestly, we've seen I've seen a lot of juniors put out some tremendous drill results in the last 2 or 3 months, only to be met with very dismal trading and essentially a liquidity event for their stock. So I mean, it's the whole going about how you try to compete out there with the huge number of juniors for awareness, that has to be rethought. I
Yeah.
think everybody is saying that, but it has to be rethought.
Mm. It's potentially also just easier said than done because with risk being off the market, how do you attract people to the one of the riskiest sectors out there?
Mhm.
And the market just doesn't have appetite for good results. It only has appetite for tremendous results.
Exactly.
Something that's never happened before. Nobody cares about good or good enough results at this time being until they do, of course.
Yeah. And
So
no, you're quite right. And what we've seen, where I was talking to some bankers and brokers recently, and they said, Phil, there's a lot of money, that's being pulled out, and it's just sitting there on the sidelines. People just can't convince themselves to get back in. And I guess, um, and when they do, then they just have knee-jerk reactions. In our case, we have a good story to tell, and we're going to be drilling.
yeah.
And the results will essentially, the way we'll present them, because of where we're drilling, I hope people will say, okay, they've built value at Chimo. It's as the founder of Agnico once said, gold in the ground does not rust, right? So it's not going anywhere. And we're going to just simply demonstrate that we could find a lot more very quickly. And if it behaves like Chimo, then that's what we're selling. We're selling a lot of blue sky on top of something that's already demonstrated to be economic standalone. So
And then hopefully the market is there to give you value for it again because it's that tree in the woods. But what if I understand you hope that it's not going to be the case. I hope that it's not going to be the case either. But what if you come out with results? They're good, they're definitely good enough, but the market just doesn't care. And then at the end of the program, you have to raise capital again. Have you like how do you deal with that whole situation? Do you sell any of the other projects that you have? Do you go to a royalty company? How do you deal with that situation of raising capital in potentially another soft market?
by now, obviously, because of our share structure, we're giving that a lot of thought, right?
Mm.
And so not only are we meeting with corporates, but we're meeting with royalty companies. We are always looking for the best way to keep advancing. Well, best way meaning least dilutive way, right? But surrendering part of your deposit or selling at a discount is clearly dilutive, or it's not matching what the expectations of our shareholders. So listen, it's not an easy answer. The action for me is always the way forward. I mean, if we weren't going to be drilling, that one way somebody could interpret that is by saying, oh, there's nothing else to be done at Chimo. And believe you me, there's a lot to be done still at Chimo, not only from a blue sky exploration perspective, but as well in and around the shaft area. I mean, it's just finding a way of unlocking or untrapping Cartier was the share price, which seems to be trapped in the 10-cent range. If you just unlock that, then if we were trading at the same share price that we were prior to the '03 acquisition, right, we'd be $120 million market cap. Yet the acquisition itself unlocked tremendous value under one roof by one company. And yet, but it's small consolation to be in a situation that most juniors have gone through. I mean, a lot of the juniors are down. But I think where we're excited is we've got this tremendous flagship asset. We've got cash in the bank. We've got an exciting program for 2024 that we could pace ourselves through and provide tremendous news. And our fallback and part of the foundation that we built was, meeting and getting awareness created around the PEA that we generated last year. So
Right.
it's great times for us, actually. Market may be soft, but we're advancing.
Right, but that's pretty much the summary for what's happening in 2024. It's the 25,000 meter drill program, and you're advancing that. That specifically on well, two of the land claims that you have out of the seven in total. You told me that three of the seven in total are sort of on the shelf right now, which means that next to these two they have, so the Chimo mine and the new one that you acquired to the east, you have two other assets that are not on the shelf, but also not necessarily active. What's happening there?
Okay, well, in 2012, when we acquired Chimo in 2013, we also acquired the Benoit deposit, the
Mhm.
Fenton deposit, and the Wilson deposit. Um, at the same year we acquired the O3 ground, we acquired 100% of the Fenton deposit from the Quebec subsidiary Soquem. So right now that project, and in fact, when we just before the transaction with O3, we were set and ready to drill. You're like really high grade, tremendous targets on Fenton, but obviously we had to shelve that. So we could always go work on Fenton, but we could also joint venture it. Whereas Wilson is currently optioned off to was optioned off to Hawkmoon, which renamed itself Wise, and they're looking to continue the option into the third year, I believe. Another project, Delier, was optioned to Delta Resources, and Delta has had tremendous success on Delta 1 in Ontario, but their Delta 2 project is adjoining to the one that we optioned to them. And they're in year 3 as well of the earn-in on that project. Whereas the other assets, while I wouldn't say they're non-core, but they're way less advanced than what we're working on right now. Any junior would dream of having assets like that. It's just that for us, because of Chimo and Benoit, Wilson, and Fenton, well, we don't see why we should be working that level of grassroots level projects, right? So,
But do you have any of those juniors who would dream to have that kind of an asset? Do you have any of those approaching you and trying to option it or buy it from you?
yeah, I guess I'm mostly responsible for that. Well, I haven't dedicated or devoted any time to reach out and try to option these things because I'm obviously very focused on Chimo, right? But I'm not saying that part of 2024 might not be part of my efforts might not be to find a home for these things so that they could stop collecting dust on the shelf
Mm.
and get moved forward by somebody else's money and efforts.
Right. What's the holding costs on your total land package? Do you know that by heart?
I don't know that by heart, but we have about 800 claims. Let's just say every 2 years, we have to roll over about $1,200 or $1,500 credits per claim. We have more than enough credits from historical expiration. So it's basically a renewal cost of about $50 or $55 per claim. So
Mm.
55 times 800 claims is
So it's minimal. It doesn't, I mean, it's not a concern. That's what I'm
now it's not a concern in terms of cash. And as I say, we're very fortunate that all of our assets were, had a lot of expiration credits in them. So we're able to keep these things alive for quite some time now.
right,
At least
right.
at least almost another decade.
That's true. That's true. That's well put. But I'm wondering about those. I mean, I'm thinking about those assets because they're there. Clearly, the market is not giving you any value for them. The market's not giving you any value for most of what you have, as you just told me. But there are, I mean, they do have a monetary value, whether the market wants to acknowledge it right now or not. They do have a monetary value. So talk to me or help me understand then what a potential partnership might look like there. Like if I came to you in January and I said, Philippe, I want to work with you. I want to start my own company. What would
Yep.
you want from me to close a deal on some of those assets?
Typically, an asset like Fenton or Benoit, you're looking at cash, shares, and expenditures. Since those assets are drill ready, you don't want them to go into doing any sort of geopoetry, and soil sampling and geophysics. They're drill ready. I mean, they have established drill showings on them, and so let's just say look at the deal structure we did with Hockman on the Wilson project. I think to acquire the project, they have to expend $5 to $8 million. They have to provide us with cash and shares so that if they're successful, we're successful, right? And and we never joint venture a project and for it to become a Mexican standoff. So, and I'm all for joint venturing projects like that because at least they get advanced. But understand that if it's difficult for companies like Cartier to consider continued dilution for an asset like Chimo, well, imagine a junior picking up a project that's less advanced than Chimo. But then again, it's a sweet spot, right? Because Chimo is a level where, very fortunately for us, we have that expanded exploration stretch. Because any future work in and around the shaft itself, well, you mentioned it. The next step is almost a feasibility study, and those things start to get expensive, right? But early stage exploration is usually quite affordable, and that's the type of work that we'd be asking for, an incoming junior on Benoit or Fenton or McCormack, right? So it's quite affordable, and if it's a local company, they could operate it themselves. If it's a foreign company, we could offer to operate it for them, right? Because Quebec is Quebec, and we're very flexible.
Well, I'm sorry to disappoint you, but I talk into a microphone for a living, so I'm not looking to overcomplicate my lifestyle here. But it makes sense to me that would be the case. What about, I mentioned it right there. I alluded to it, but what about a royalty company? Is that something have you spoken to any of the royalty companies? Is that something you like or dislike?
It's okay, just for people to understand, usually or historically, people don't sell royalties because royalties are perceived as encumbrances, right? Or a drag on an asset. But what we've seen recently is royalty companies do these hybrid finances. They buy a royalty from you, you get the cash without having to print shares, and the deal is structured in such a way that that royalty itself doesn't prevent the company from being able to transact or sell the project to a third party. In other words, there's a buyback provision where the royalty company can gain without itself being its own worst enemy. If you've put in a royalty structure on a project such that it's such an impediment on developing the asset, well, it's basically lifestyle company description right there. So we will. This is something that we have definitely considered in light of the fact that we've seen royalties be purchased for good amounts that allow you to continue advancing the project, but the royalty itself not being an encumbrance on the project for future transactions or selling to a third party.
So, I mean, you're not opposed to getting a royalty in on Chimo, but it's deal dependent.
Yeah, it's deal dependent, and it's not our first choice. And so, obviously, we're not out there as our first. It's not our first choice transaction. Our first choice transaction is something that rewards our shareholders. In other words, selling Cartier or selling Chimo Mine Project, and/or merging with somebody that can continue advancing. And then comes the royalty thing.
Right.
But and we've seen royalties are good for royalty companies as long as there's production and you see a revenue stream. But a lot of these royalty companies some of these royalties are disappearing. And so they need to replenish their portfolio of royalties. And so they're shopping, right? Because and they're sitting on a lot of cash to do so.
What about money from some of the people who are already in your story, that being Agnico or O3? Is that on the table? How's the relationship there?
Well, that's always on the table. The relationships are excellent. O3 are going through their own development phases, right? They're focused on Marban. And as long as they have above 10%, they have all their top-up rights, participation rights. Agnico have grown considerably since they became our sponsor in 2016. They've merged with Kirkland Lake, they've bought Yamana, they're reassessing their whole thing, and they still own 14% of Cartier, and as in O3, as long as they hold over 10%, they have all their rights, participation right, top-up rights, a right to put somebody on the board. So you know right now, all the companies that I know of are in that same strategic thinking process, where
Hmm.
they're going next. And it's exactly the same for Cartier. We're trying to
Right.
map the future years with, obviously, our prime focus is rewarding our shareholders.
Hmm. Hmm. And that's well, that's pretty much it. I mean, that's that last sentence is pretty much why you're doing all that and what you're
All
doing here. Um, what else? I think I've been through most of the notes that I have on here. Looking at them right now. But what else is something that you came here hoping to talk about that I'm failing to bring up?
Well, not really. We're action driven in 2024. That's why the raise. We've got the money to do that. We've created a solid base in and around the Chimo mine shaft area for, to entertain, discussions to monetize that for our shareholders. So we've set the table for a very dynamic or exciting start of 2024. What are the markets going to throw at us, right?
Hmm.
what what are the markets going to be like? But suffice to say, we're there. We're cashed up. We're going to be working, and I have a feeling the first quarter of 2024 is going to be good for us.
Hmm.
And if it's good for us, it's going to be good for a select few juniors out there.
I really hope you're right. One thing that I am noticing here in my notes though that I didn't ask is that we didn't talk much about the local communities and your relationship with them there. So, well, obviously, let's just mainly talk about the Chimo project. If you want to throw in some of the other projects and tell me how the relationships there are, do go ahead. But yeah, what's the relationship on the Chimo mine?
The Chimo Mine project is we've kept open channels with the local municipalities, the outfitters, the local First Nations, like Seminole community. They've in last year they went through an election process where they brought in a new chief and band council. So they're slowly getting their transitioning the information. That's good. Right now, as you've probably seen, there's a lot of activity for lithium projects. So that's a lot of the local concern groups are adapting to that, right? So, but the name of the game for a junior company like Cartier or Probe or O3 is always to be ahead of that in terms of what we can do at our scale of a company, right? Because at our scale of a company, what we want to do is to have the best relations possible and have memorandums of understanding and keeping them well informed of where that asset's going. Because ultimately, the money or the concerns that these communities can only be addressed by the development of the project, and that is essentially going to be done by a very large mining producer. So you don't want to jeopardize the future relationship between those communities and the producer that have the capacity to address those concerns or those monetary demands. So at the level that exploration companies work, it's always keeping open channels, being informing and being very in tune with those concerns, be they environmental, social, or whatnot. The Chimo Mine project being an underground project,
Mm.
obviously gets a little less pressure than a project that is, building itself as being an open pit. Because an open pit project, well, that's not going to be carbon neutral, and that's going to disrupt the surface area. Whereas an an underground operation has a much lower surface footprint
Mm.
or environmental impact than an open pit. So that's an added benefit of Chimo. And because Quebec has a superb hydroelectric grid, that has a tremendous positive impacts on development of an underground situation like the Chimo mine project versus any other surface open pit, right? So
Right, right. But I mean, for this 25,000 meter drill program, everything is in order. You just go ahead and.
yeah, what the permits are all obtained and received, and we've ahead of the game. We always go and discuss with the group, saying this is what we're going to do, and when they see or figure out that it's low impact stuff, right? And we happen to be operating in an area that's already been heavily lumbered out. So the impact was actually done by the lumber companies, and we're actually going in there and going back onto areas that have already been lumbered out. And so our environmental impact right now is not significant. But that doesn't mean that we don't have to do the baseline study stuff
Right.
and keep them informed.
So you don't have any provisions or anything that you have to set aside, as in like a 10% of the drill program, or something that you have to have in a fund that's locked up.
Not at our level. And in our case, it's all preemptive. What we've done is we map out our program, and if there's a less impactful alternative, we always go for that first. And
Mm.
as I alluded to, in any world, we would have done the holes in just the numerical order. But in this case, okay, we're going to do these first because winter has less impact on the swamp areas and the wetlands. And then we're going to do the stuff we can do in the summer. So there's attention to that detail of environmental constraints. Well, weather constraints, so to speak.
Mm.
Some targets we'd like to do right away, but we'll say no. We better do those only during the winter months versus the summer months.
That's a
So
good
it's
point.
the logistical concerns is, and if you're going to be drilling in an area that has a high volume of, let's say there's skidoos here, the winter sports,
Yeah.
and that, well, why don't I do that drilling in the summer? It won't bother or if you prefer, there's areas where we want to drill that is beneficial to the local outfitter because he has hunting groups and fishermen group coming in during the summer. It's better to do that drilling in the winter rather than the summer, so on and so forth. There's attention to that type of detail that a lot of people don't appreciate, but that goes on in the planning.
And I assume an added layer of complexity, something that may be an added layer of risk that you have to manage, is forest fires. Because last year you had to stop drilling, if I'm not mistaken, due to forest fires.
Absolutely. When we throw out, when we go out for permitting, we put our names on the list of the alerts by the forest fire groups. And so when we stopped drilling last year, we actually stopped because the quality of the air was low. And with the drill contractor says, well, might as well stop. We'll wait a week and we'll go back in. But in the meantime, we got the call from the government saying nobody's allowed in the bush anymore. So we had actually finished or completed our drill program, and we were on the verge of doing phase 2 or adding or going beyond the planned 25,000 meters when the forest fires hit. But you're quite right. And in some cases, the forest fires were so intense that the government has added an extra year to the land management. So if let's say credits or exploration work was due on a specific claim for that part of the ground, well, because of the forest fires and the fact that you couldn't go in the ground, well, they've voluntarily added an extra year for you to file that work. And that actually impacted us positively on the eastern portion of the East Cadillac project, where we were given an extra year to do some work up there and file work.
Mm. Little bit of a silver lining there. Okay. Is
A
one
bit of
port, so is that east portion of your land package more at risk to forest fires, or is it's just the entirety?
No, I think part of the issue this year in the forest fires, and there's an inquest going on, but part of the reason was that during the earlier part of the summer, it was especially dry out there, and usually they prevent people from going in the bush and forestry companies. And this time they were slow in doing it, and the forest fires just took off and they lost control. And the second reason is, as one of my First Nation friends pointed out, in and around this area, there's essentially a monoculture of pine trees, and historically that wasn't the case. There's a bunch of different tree species all over the place, which would have been a natural barrier to the progression of forest fires. But because of intense logging, when those fires started, they just barreled through the territory, and so I think they're going to have to rethink the way they proceed with the exploitation of the forest here in Quebec.
That's right. Something that's even in Belgium, we don't have much of nature, but there's sometimes you'd have these parks that they have to manage because of in some parts of the Flemish region in the country, with they had coal mines here, and to build those coal mines, they had to plant fields of trees basically, and all the same trees. And now they're trying to manage that same thing so that they don't have the forest fires. Yeah.
So when you have a monoculture and the pine trees are, when they are dry, when they set on fire, they just ignite.
Mm.
Whereas, like I mentioned, if nature had been nature and they would have several different types of trees, you would have had natural forest fire barriers, and it probably would not have been such widespread forest fires.
Yeah. Yeah. That's right.
But
Okay.
again, I mean, it's not to dish on the forestry industry. The mining industry has made tremendous steps in respecting and understanding and going towards the population concerns of how they go about exploring. But there's a whole different set of rules for the forestry industry here, and so be it.
So how are you managing that risk? Like, do you plan to ramp up right before it and have it calm down by the time it's the season for forest fires, or how are you managing around that time?
Well, in this case, it was exceptional. Usually, we simply monitor the heat and the dryness seasons, and we basically adjust. And if we get an alert to stay out of the bush, we're out of the bush. In this case, it just flared up and everybody was affected. We're proactive versus reactive in our industry because the guys are isolated in their drill shacks and so on and so forth. So we're the drilling company, ourselves, and the ministry are always interacting to make sure that if there's a caution out there to stop, slow down, or prevent work, that's what we do.
Hmm. Okay. Good. Good. Well, that was a nice little tidbit at the end that I appreciate hearing about something that you don't typically hear about in these
Well, you
conversations.
more than hear about it when you drive down the highway here in at the beginning of summer. There's these large billboards by the highway with inflammability index, and it's meant as information for campers, hunters, fishermen, people, picking berries or whatever, and working companies. So you have low inflammability to high inflammability. And when you get to a specific level, there's actually advice given to populations to just stay out of the bush, or you can't have open campfires and so on and so forth. So it's quite proactive throughout the province. And if you ever come here to Quebec, and it's in Ontario is like that, Quebec, I don't know the other provinces, but there's these huge billboards with little arrows showing
Hmm.
the danger, the level of danger there is associated to that.
I've never been to North America, so I feel invited right now.
Yeah, it's wonderful territory actually.
I can imagine. I love the mountains. I love nature. Some days I wonder what I still do in Belgium, but good point. Thank you,
Belgium's a
Philippe.
wonderful country.
I don't think I have any other questions. Anything that I'm missing, important things that you want to talk about here at the end?
I think you opened up by saying investors should do their due diligence, but when investors they have a focus on gold companies and they like low risk, high reward situations, I think that if they do their due diligence and homework for companies such as Cartier that are in the Abitibi and have assets like the China Mine project, they will rapidly see the value proposition. I do believe Cartier is an investment opportunity due to the flagship China Mine project, cash in the bank, and the announcement that we're going to be active in 2024. So that's it.